So what is trading? So trading involves more frequent transactions such as buying and selling of stocks, commodities, currency pairs, or instruments. The goal is to generate returns that outperform buy and hold investing. So essentially what this is saying is that the objective of trading is to continuously buying and selling, whether you're intraday trading, day trading, swing trading. The objective is to just buy continuously, buy and sell to generate profits. Whereas a long-term investor, you buy today and you hold, you know, 3 months, usually even longer than that. Usually it's 6 months out or more, a year or even more, a couple years and stuff. So that's sort of the big difference between trading and investing. Investors are usually buying and holding longer term, whereas a trader is someone who's continuously in and out of positions. Spot trading is the purchase or sell of an asset with immediately delivering of the asset to transfer ownership. Now, spot trading and stuff is what we most people constantly hear and know about. And when you actually purchase an asset, it will be delivered to you. And for the case of cryptocurrency, when you purchase crypto on an exchange and stuff, you actually receive the asset on your exchange and then in your account, and then you transfer it to your wallet. Whereas other assets like this other one, which is futures trading, which is essentially a synthetic or derivative contract where you're basically trading um, the actual appreciation or depreciation of that asset. You're basically just trading the gains and losses on that particular asset when you don't actually own the the underlying assets. It's essentially a contract called futures trading. And margin trading is borrowing money to increase your position size with the expectation to increase your profit, but this also has the same amount of inherent risk of a large loss. So you think, well, why do people do that? Well, the reason why you margin trade is to increase your winnings and stuff. So when you go on an exchange, usually they will allow you to do margin trading. So for example, you can do 10x margin trading, or even up to 100x, which is obviously insane. So meaning that if you do a 10x leverage, meaning that if you put up, say, $100 on a particular trade, the broker will lend you $1,000. Will let you take $1,000 position. So that's a 10x margin. So basically, you're just coming to the table and you're putting up 100, and they giving you 10x leverage, and you can now trade for $1,000 worth. But the key is, or the issue or concern or risk is that, of course, you only put in $100, but your gains will now be amplified by 10x, but also your losses are amplified as well by 10x. So in fact, that's why I had mentioned the other day, when you are trading, and specifically trading on margin, it's like literally running and operating a business where you continuously have expenses that can obviously, as you can see, that can be exacerbated when you're trading on margin, and also the other expenses of constantly going in and out of trades, buying and selling, because they're trading fees. Order types. The first type is market, which is immediate execution. This is something that a lot of platforms have, like a Cash App. You have Coinbase, the simple Coinbase, Gemini, a lot of trading applications that they are encouraging beginners to come in on. And so there's only one price on the screen, and whether you're buying or selling, that's sort of the price of the market that they have on the screen. And that's sort of the market price, market order. Also on Coinbase Pro, there's also a screen on your Coinbase Pro. It also gives you the ability to make a market order versus a limit order. And essentially a market order is just that, where whatever the price is at that particular moment in time, you're saying you're willing to to purchase an asset or you're going to sell it at that particular price in that moment in time, whatever it is, which I highly do not recommend when you're starting out trading. Don't do that. If you want to save money and also make more money, you want to do a limit order, and the order which should be executed at a specific price. That's why when you begin to study and get into learning how to trade, you should now begin to do your analytics and determine what price it is you want to pay for a particular asset. And when you determine what that price is, and then you put a limit order in. And then once the market hits your particular price, and then the order will be executed. That's a limit order. On-ramp exchanges, we had talked a little bit. These are essentially American companies that have been approved by the United States government that allow them to connect their company application protocol exchange to US banks, which allows you to get your fiat, your US dollars inside the ecosystem. And that's a Cash App, Robinhood, Coinbase Pro, Crypto.com. And also there's another one called Gemini, which ironically are the guys who initially started Facebook. And, and now they are big wigs and blowing up in the crypto space with their own application. They even have a stable coin called Gemini. Why most traders lose money? One of the biggest things is toxic trading. Sometimes guys and girls, they just get caught up with just trading too much, and don't realize that you can actually overtrade because you just caught up into it. You're trying to be greedy, or it's FOMO, you're fearing missing out. You want to just get into the market, you want to just keep trading, or you're just revenge trading. You just lost, whether it was a certain amount of money or you lost consecutively on 2 or 3 trades and you quote trying to get it back. For all those reasons, create toxic trading and stuff. And toxic trading is just essentially you just like trading too much and you're not going back to your trading plan and going through sequentially all the proper steps it takes in order to determine when is a good time to actually execute a trade. Managing emotions. Again, this is something that is when you do have emotional problems and stuff, this causes toxic trading. And as I mentioned and stuff, the thing is to defer back to the trading plan and stuff, because a lot of times when you're trading and stuff, you're usually doing it by yourself. It's a very lonely profession and stuff, unless you work for a company, of course, and you're working on a trading floor and you're around other folks. But if you're managing your own money or your own account and stuff, you're generally working by yourself. So you are basically trying to manage your own emotions, and also you're going up against other people who you're trading against and stuff. So it can be taxing, emotional on you, because again, you're just like flying into space by yourself, and you're just trying to keep yourself together and still have a level head and do proper trading. But one way to kind of mitigate some of this risk in trading and stuff is portfolio diversification. We talked about that the other day, and options trading. The other ways is futures trading and understanding when you do your technical analysis on your charts and stuff that we talked about. We're going to talk more about that in the next session about support and resistance on the charts and stuff. When you start really kind of understanding what you're going to do and go through your steps before you execute a trade and stuff, it's going to really kind of zone in and hone in on your emotions and stuff. And you want to go through methodically what you're going to do before you actually execute a trade. When you start understanding where the demand zone, where the supply zone is, where my support and resistance. And when the price hits this point, okay, I'm going to put my limit order in, and then I'm going to wait until that particular price is met, and then my trade will be executed. So that was pretty much it for this particular session.